Welcome back. In this video, which continues chapter 6, we're finally going to talk about the role of money. So we've been talking about borrowing and lending and banks, but we've kind of ignored money. We've been just talking about grain, right? And grain is an interesting commodity because it's something that we can eat, but also something that we can plant and turn into more grain. But all of these transactions in the real world use money. And so that's what we're going to talk about in this video. All right, so what do we mean by money? So in some ways it's completely obvious, right? When we say, all right, give me some money, we mean either give me some cash, right? Some bills or some coins, or, write me a check or Venmo me some money. All of that is money. And so as we think about money, we sort of really want to think about what it is, what it's not, and thinking about how we measure it, because in some cases there are things that are definitely money, right? The cash and coins in your pocket, and other things that may or may not be money. And so we want to include those things sometimes and maybe not other times. Mostly what we mean by money is that it's a means of exchange. It's something that we can use to buy and sell the things that we want to buy or sell, right? So if I'm going to buy some pizza, buy a car, buy, new clothes, I'm going to need some money. And so generally that means one of two things, right? Either it means cash and coin, or it means money in your checking account. And so those are the two main pieces of what we're going to call money. Now, money also needs to serve as a store of value. Basically, that means that it needs to hold at least some of its value over time, right? Because if money loses its value very quickly, then people aren't going to want to hold on to it, and it's not going to be a good means of exchange. And then finally, the last piece of money is that it's the unit of account. And all that really means is that it's the way that we measure prices. And so, which makes sense, right? Because if we're using money to buy stuff, then we want to put the prices in terms of money so we know how much money we need to buy something. All right. So now, if we think about money, right? Now, if Julia and Marco have moved from their agrarian economy into a more developed economy, then now they're going to go buy and sell a lot of different things, right? So we'll say they're going to a supermarket, and they need something to buy the stuff at the supermarket, right? So maybe grain is the money, right? Maybe grain is what is used in this economy, and they can use their grain as payment in order to accept their goods and services. But Marco, remember, has deposited his 50 kilograms of grain into the bank. And so the bank says, yeah, Marco has 50 kilograms of grain. And if he has an app on his phone or a card or whatever that allows him to transfer some of his grain in the bank to the owner of the supermarket's bank account, then that is also money, right? Even though we know that the bank doesn't actually have that 50 kilograms worth of grain, right? It only has the 10 kilograms because it lent the 50 to Julia. And so we call those bank deposits, right? The money in your checking account, especially, but now also savings account, as bank money or bank deposits. But it's really just money, right? It's hard sometimes to get your head around because it's really just ones and zeros on a digital record. But as long as the bank says that you have the money and has given you a way to transfer some of that money to somebody else, then you are using that to buy goods and services. That's the definition of money. All right. Now, the other thing that we need to the other sort of two pieces that are important are reserves and base money, and they're very much related. So base money is a liability of the central bank. And so the central bank is the bank that basically regulates all of the banks in the economy. And the way it works is that banks will have an account at the central bank. And so they will say, all right, I'm going to put, $200 million into my account at the central bank. So now the central bank owes that $200 million to the other bank. And we call that money reserves, right? And so the reserves play an important role in the economy, but they are not actually money because they are not being used to buy and sell things. And so we generally don't include them in our general measure of money, but we do include them in what we call base money. And the other piece of base money is currency. So currency, which we do include as regular money, right? And reserves go up to make the sort of base money, or in the United States, the more common term is monetary base, but same thing, base money, monetary base. Now, reserves are important because reserves can be converted to currency, right? So if you're a bank and you say, hey, I've got an account of $200 million with you, but I need I need $50,000 of currency because in order to pay my depositors, that can happen. So that's one reason that the currency and reserves are both liabilities of the central bank. Reserves, as we'll see, can also be turned into real money through loans, but we'll talk about that a little bit more later. All right, so base money includes reserves and currency. Money, just regular money, right, includes currency and bank money or bank deposits. So there is some overlap, right? That currency is included in both measures. All right. So if we think about sort of bank money versus bank notes are just cash, right? Bills. Bank money is a liability of the commercial banks because that's the deposits that depositors have made. And so, if you've put in $5,000 into your bank account, that's your $5,000. And so the commercial bank owes that to you. We call that bank money. Bank notes, on the other hand, are a liability of central banks. So the cash that we have, because the central bank, it's a little bit of fiction, right? It used to be that you could take those bills and trade them in for gold or silver or something. But now we're just saying the central bank promises that they will continue to have value as a unit of exchange and a store of value. So in our sort of modern economies, right, where we have lots of different currencies, we generally think of the money as being both banknotes and bank deposits. And those are generally what we consider. So in the United States, we have M1 and M2, which we'll look at in just a minute. They're pretty much the same these days. We used to not include savings accounts in M1, but now we do. So that was the big difference between the two. So now they're pretty close. All right. So now let's think about the central bank. We talked about the central bank in chapter 5 because, as we said, the central bank is in charge of monetary policy, right? They're in charge of setting the policy, right? The interest rate that's going to try to get us at their inflation target, and which also should get us at our supply side equilibrium. But the central bank also has a very important role in terms of regulating banks. And so we want our central banks to make sure that the banks will have enough capital, have enough liquidity, that they won't be subject to bank runs, that they'll be healthy, that they won't go out of business. And, a good central bank regulation allows all of those banks to actually function. And one of the things that's going on, right, is that the central bank is making sure there's enough base money in order to work. All right. So we've talked about monetary policy already, right? So monetary policy's goal is to set the policy rate to meet the target level of inflation, keep us at our supply side equilibrium. And therefore, the central bank is trying to keep inflation. Now, inflation, remember, means that prices are going up. And so inflation is actually saying how well does money keep its store of value. So if we have a $100 bill and there's 2% inflation over the year, then that $100 is only going to be able to buy you the equivalent of $98 worth of stuff from the previous year, right? So it's lost some of its value. If inflation is 50%, right, now that $100 bill is only going to allow you to buy $50 worth of stuff compared to the previous year. And so that store of value has been much worse. And so inflation is really important in terms of how well the currency is holding its value. And in economies with a weak central bank or a central bank that doesn't have the right institutions in place to regulate the banking industry, that can be a big problem, and money can lose its store of value more quickly. So the central bank has a sort of somewhat complicated balance sheet itself, right? So we've talked about the central bank liabilities. So one is currency or banknotes, and the other is reserve accounts of the central banks, right? Of the commercial banks, excuse me. So the commercial banks have accounts with the central bank and reserves, and that's the monetary base. But it also has assets, right? And so its assets are going to be mostly government bonds. And so in the United States, that's treasury bills, treasury notes, treasury bonds. And one of the issues that we talked about in Chapter 5 was when the central bank lowers interest rates all the way to the zero lower bound, and it can't lower them anymore. What does it do? And so after the financial crisis in 2008 and 2009, the central bank in the United States, the Federal Reserve, engaged in quantitative easing. And what that meant was that they tended to buy more and different bonds. So they bought longer term government bonds, but they also bought things like mortgage-backed securities. And the goal there was both to lower long-term interest rates more directly, right? So we know that it sets the policy rate, which is a very short-term interest rate. So they were trying to lower long-term interest rates, but they were also trying to make sure that the banking system was healthy. And so they were buying a lot of these mortgage-backed securities that other people did not want to buy. And we'll talk about that in more detail in chapter 17. So this is still going on, right? So we're in a world now where the Federal Reserve's balance sheet has increased a lot. That meaning both its assets and its liabilities have increased. Now remember, its liabilities are the monetary base in the economy. And so that means that the monetary base has increased a lot. Why have they done that? Well, partly it was to get the banking system back under, back in control after the financial crisis. Partly it was to lower interest rates long term after the financial crisis. And so they were able to buy a lot of bonds from areas that they wouldn't typically buy from. Was it successful? There's a lot of debate about that. So there's definitely clear evidence that quantitative easing seemed to increase the stock market, but that wasn't really its goal. A little bit less evidence that it was able to increase inflation, which was one of its goals, because inflation was actually below the 2% target. And less evidence that it was able to decrease longer term interest rates. So The central bank, I mean, I guess that means that the central bank is not omnipotent, right? It does not have necessarily all of the tools that it would like in order to manage the macroeconomy and get us at that supply side equilibrium and that 2% inflation target. But it also means that the result of this quantitative easing was that base money increased a lot, which means that banks had a lot of excess reserves, meaning more reserves than they were required to have. So uh, traditionally, banks in the United States have been required to hold about 10% of their deposits as reserves. Um, but then after the financial crisis, they started holding lots and lots and lots of extra reserves above that 10%. And they were holding so many extra reserves that our sort of traditional monetary policy broke down. And so we made a few changes in the United States. One was we said, hey, you don't have to hold any reserves. So now the reserve requirement is zero. They could change that, right? If they started getting worried about inflation, for example, and wanted to rein in some of that lending. But right now it's zero, but banks are still holding a lot of excess reserves. And because of that, banks don't need to borrow and lend reserves from each other as much, which means that the federal funds rate, which is that rate at which they borrow and lend reserves, is less important. And so now the Federal Reserve actually pays interest to banks on their reserves. And that then is sort of the base interest rate. So if the Federal Reserve still says, okay, here's our target for the federal funds rate, but they also say, here is the interest rate on reserves, and those two are basically the same. So here are just some graphs. So this is sort of the monetary base. So remember, that's in the United States, the reserves that commercial banks have with the central bank plus the amount of currency. And you can see it basically increased with the size of the economy fairly steadily until the financial crisis. And then it made some very big jumps. These big jumps were the result of quantitative easing. The Federal Reserve started to decrease the size of their balance sheet until the pandemic came along. And then again, they had two big jumps in the monetary base. So it went from about $900 billion in 2008 and to over $6 trillion in 2022, and is still, over $5 trillion, over $5.5 trillion, really. And so that's a different world, right? And that's means that some of our sort of traditional explanations of monetary policy are not quite right. We need to introduce that concept of interest on reserves as that sort of now base interest rate in the economy. Now, we can also look at what we call M2. So traditionally, we looked at sort of M1. M1 was cash and checking accounts. But now we've added in savings accounts, which were the big piece of M2. M2 also includes things like certificates of deposit or CDs and money market accounts. But M2 is a generally sort of a more inclusive measure of the money supply. And again, you can see actually that there was not a huge increase in M2 during the financial crisis. There was some increase, but not a huge increase. And it kept going steadily along, but there was a large increase in M2 after the pandemic. And a lot of that was because of all the extra benefits that the government provided, right? We provided extra unemployment benefits. We had stimulus checks that went out. And so there was this big jump, and that was probably one of the significant causes of the higher inflation in 2021, 2022. But you can see one of the things that we really sort of most care about is the ratio between the money supply and GDP, and that's what that red line is. And so you can see it was kind of steady between about 0.5 and 0.6, and then increased sort of after the financial crisis to about 0.7 before jumping up to about 0.9, but now has come back down to about 0.7, right? So this is probably why our rate of inflation has come back down as well. There's not as much extra money in the economy. And so I think it's interesting, it's important to realize that the big increase in reserves here in the financial crisis did not cause inflation. But the big increase here on the pandemic, which was seen also in M2, did cause inflation. So in the UK, of course, the central bank is the Bank of England. And the government owns the central bank, basically as it does in the United States, although it's a little bit more complicated. It's like a public-private partnership. And because of that, any bonds that the Bank of England owns is just basically saying that the UK government owes itself that amount, right? Because the UK government owes that to the central bank, but the central bank is owned by the government. But this is, so like you could imagine saying, all right, well, we don't really need to pay that back. But we do, right? Because otherwise, if we didn't pay it back, it would, go through the economy and would not, investors would lose confidence. You would not work. And so this is true in the United States as well. The United States owes itself not only through the Federal Reserve, but also through other agencies. We owe ourselves a lot of money, but that does need to be paid back. And the only way to pay that back, of course, is either through increased taxation or more borrowing. And the problem with government debt in general is when it gets to the point where you're borrowing more in order to pay the interest of your previous debt. And that's when it tends to explode. And that's when governments tend to default on their debt, either directly or through higher inflation. All right, so we'll stop there. And I think we have a few more videos for Chapter 6, where we'll talk about sort of more directly how the banking system and the monetary economy are related to the real economy.